Live.
I was just saying, Amit, I feel like that's the unspoken agreement with anything that you send Amit. It's just like you silently sign some type of agreement saying that you're liable to be publicly
Yeah.
ridiculed and or screen capped.
No, because there's some stuff that just should not be on Twitter.
The fact that you
Don't
what did
send
you
it to
do?
Amit.
You sold shares or something to buy World of Warcraft gold, or
That's exactly what he did. So this is what Steven sends
Wait.
me after a good week.
Did
Just
you?
here's to a good
Did
week
you
in the
up-
market.
oh, okay.
I mean, he got his lung killer, and then I'm like, here's what I'm celebrating with some gummy worms, and we just have a.
There's men and then there's men.
So real quick, Tanner, do you play World of Warcraft?
I don't play World of Warcraft. I've played World of Warcraft, but honestly, growing up, I was all about RuneScape, and World of Warcraft was a scam. So
See, I think Amit is missing a huge sector of content because there's a way bigger sector for gamers than financiers, and we could do this. You know, we could do some arenas, we could do some twos.
Bro, video games are the most
Bro.
fucking boring thing to do on the planet. Like, I don't know how
Steven, don't get him into World of Warcraft, man. He already doesn't get laid enough.
dude, the RuneScape Grand Exchange might be bigger than the actual NASDAQ. So, like, who knows? We might have to switch over to RuneScape trading instead.
There's a lot of content.
Look, I
Is it
tried
so?
to get into video games when I was little. I had a PS2 and I had Grand Theft Auto, but it's just kind of boring, bro. Like,
Yeah, you
Finance is
haven't
way
played
more fun.
World of Warcraft, so I think you should try it.
Hello,
Actually, no, I
everyone.
take that back. Don't, because if you end up liking it, you'll lose.
Be addicted.
years. So,
you know. All right, Tanner, introduce us.
Hello, everyone. My name is Tanner Manson. I am the host, the founder, the CEO, the president of the Sofi Weekly podcast. Introducing is just a couple of guests. You might not know them. They don't
Why do you sound like
really-
ChatGPT, bro? You literally
Hold
sound
on.
like ChatGPT.
Well, let me just
He
read my
sounds
script.
like
I just asked it to do an intro, so let me read
Tanner,
my
I
ChatGPT
have a
intro.
question. Do you collect baseball cards?
No, and I've told you that's a waste of time. We're in the middle of an
the way
intro.
that you just said that, you sound like sports card investor. The way he starts his videos. Identical.
You're derailing me. Okay, guys, introducing in the
Did
other
you say,
corner.
Steven, you want him to rail you? Is that what you said?
Jesus Christ.
In
Why
the
did I
other
wake up for
bottom
this?
left-hand corner is the biggest distraction of the podcast. Steven has come here to talk about baseball cards and World of Warcraft, video games, and anything other than investing. on my left here, TanGPT. Yes. Thank you, MGR. And then, the other two are Amit and Tevis. Hey, guys.
All right, so stocks went to the moon this week. Nvidia up 30%, Palantir up, I think it's like almost 20% for the week. If 108 stocks hit their new 52-week highs this week, including Apple, Microsoft, Netflix. I guess let's start off with you, Tevis. I was actually on the phone with Steven today talking about this. What do you think is the catalyst for why the market went bananas when Fed Chair Bullard says we're expecting 2 more rate hikes and the debt ceiling has not been negotiated yet for a fact? Why do you think the market decided to rally this week?
I mean, the market's been kneecapped for the past 6 months. I think that a lot of the stuff that was going to be priced in has been priced in from a macro perspective. And I think that investors just on aggregate, like taking aside this subset of AI hype, which is tackling NVIDIA and Palantir and all of these related stocks, putting that to one side for a second, I think that, in a large part this week, the good news was with regards to like debt ceiling stuff. Basically, whenever everybody expects the market to go down, that's when you should be looking to see if the market's going up. And Biden came out and said, hey, well, if this thing doesn't get signed, then US defaults, we're going to get a 45% dip in the market. Obviously, markets rallying on those talks. I think the second point that you mentioned is more interesting with regards to more hikes, because very recently consensus was that we wouldn't like it was iffy whether we were going to get one hike or a complete pause and then possibly 2 rate cuts by the end of the year. I'm going to send you a chart, Amit, in our private chat here. And I want you to put that up because what this chart has is the meeting probabilities for the Fed and what the consensus is for that meeting. And so you can see.
Ooh, this is cool.
Mm-hmm. So let me read this out for you. It says interest rates, and by the way, this was posted yesterday on Friday, and it says interest rate futures now pricing in a 25 basis point hike in June after PCE inflation unexpectedly rises. There is now a 57% chance of a June hike and a 27% chance of another hike in July. Interest rate cuts now not expected to start until November. Only one cut is expected for entirety of 2023, while 4 cuts were previously expected. If you'll remember, Sofi and their consensus had 2 cuts for the year. And it continues by saying in the last 2 weeks, just 2 weeks ago, no rate hikes were expected and cuts were beginning in July. So that's how quickly that can change. And on a macro level, I think that it's going to be affecting the market, not necessarily to the positive. And I think that we might be seeing something like this start to be priced in. Well, it started this week, but more so next week, as these conversations have been somewhat ongoing.
Okay. So do you think then, Tevis, we get the 2 rate hike cuts that Noto and team said they're considering in their estimates?
Well, I mean, so, okay, here's the thing. The Fed has now gone down a path of no return because the worst thing that can possibly happen is they cut too soon and then inflation starts to come back up.
Correct.
Right? So they would rather hike for much more for a longer period of time to make sure that this thing is not coming back up again in 6 months or 9 months or whenever, right? And so I think that we could not see a hike when we expect. I don't think 2 rate hikes at this point seems realistic. But I mean, look, we've seen how fast this information can change, right? Like it said in the post just 2 weeks ago, it was a completely different macroeconomic picture with regards to what the Fed is going to do. So we could be in a scenario, and we know the Fed lags, but we could be in a scenario where, we get another rate hike and then July comes around and then it's iffy if we're going to get the final rate hike. Let's say we get that too. All of a sudden they've raised way too much, and consensus is that they've raised way too much. If you see some more things breaking, particularly in the banking sector or probably some other sector is going to hit, another shoe is going to drop, then the consensus can be very quickly to change after that if they decide that they want to start cutting faster or if they want to start holding it out for longer, right? But at this point, it doesn't seem very enthusiastic that we're going to get 2 rate cuts by 2023. But that's fine. Like, I think a large part of that has been priced into the market and will continue to be priced into the market as we go forward in these next couple of weeks, right? It's not necessarily that investors want to see, rate cuts immediately happen. It's just that, hey, first and foremost, we are quote unquote out of the woods in terms of rate hikes. Like, we know that's coming to an end, and we know that there's going to be a pause. And then we have an idea of when the rate cuts are going to be. But as more time passes, more of that gets priced in, right? So I think that a lot of investors, and look, I don't want to chew my words a couple of weeks down the line, and maybe, but I think that a lot of investors on aggregate are acknowledging the fact, or have been acknowledging the fact over the past couple of months, that we are out of the woods or starting to see the light at the end of the tunnel might be a better metaphor.
Okay, Tannor, your thoughts and your reaction to this market mooning this week?
I mean, yeah, I don't know how sustainable it all is in the short term.
So you think it's a bubble?
No, I'm not. I'm not saying that. I'm just like, it's always hard to see whenever a recession starts or or ends or anything along these lines. The indicators are very gray, and that's why the call outs happen, 6 months after it's even happened. So optimism is definitely coming back, but this is not the first time in the last 2 years where we're starting to see a run back into stocks, and who knows? Right now, I'm not selling anything. I just don't operate that way. I don't try to time the market. I just try to buy more whenever I get paid. And but yeah, my portfolio has been really, really liking these last about month or so. So very, very exciting. And Palantir has been I think the best position that I have in my portfolio so far, not in terms of absolute dollars, but in terms of gains that have been made in the last year. I think Shopify was second. And then, well, Nvidia and Nubank as well.
Steven, your thoughts on this market?
So you and I had a conversation earlier about the Fed. Was it not pretty much what Tevis said?
Yeah, pretty much.
So
I still think we might get one cut by the end of the year.
Hey, Steve, real quick, can you lift that mic up for me? Just lift it up into the camera. I'm so sorry to do this to you.
Why?
Yeah, can you just turn that around 180 degrees, my man?
Does it really make a difference?
Very
I knew
much
that
so.
was
Thank
coming.
you.
Oh my God. These
I can hear you now.
Possibly also
You can
tilt
hear
it
me
like 30
now.
degrees.
Yeah.
Steven, you see this like tilted a little bit to you, just so the
No, away from you.
Okay. Send me a link of what to buy.
Just tilt it.
I'm gonna buy a whole
tilt it to your
setup, so I
screen.
don't have to go through this.
Tilt it to your screen.
You have
To
to
my
act.
screen.
You have to tilt
like
the
that.
tip near you. Like let the
No,
tip get
Amit's
closer.
wrong. Amit's 100% wrong. Don't listen to him.
No, let the tip in, just the tip. Let it.
So the sheer mic comes from here. The blue Yeti comes from here. Comes from the front. All right, we're done. Don't listen to Amit for audio advice. This guy had a crackling mic for like 6 months.
Hey, I fixed it. Look, you got to buy this. It's a $400 mic. It's a nice little setup. You can afford a $400 mic, and you got to get you to be a professional. That's it.
Send me the link for everything.
I'll send you a link. But anyway, so Steve, do you think the Fed cuts at all this year?
My opinion is if they cut, it's not going to be till November, maybe December, but I don't think they're going to do it. Powell and the Fed was behind the whole time. They were wrong. Everybody was wrong on transitory. It became a big word, transitory. You can't have oil at 130 and 140 a barrel and think that inflation's transitory. That's not how economics works. Oil and gas are the biggest inputs for manufacturing. They are the cornerstones for plastics. They touch every part of our lives. That goes up. The feedstocks go up. Phosphorus went up and fertilizer went up. Phosphorus is a very large component of fertilizer, making food costs go up. Inflation is making things very bad, and Powell cannot be wrong again. Like Tevis said, the worst thing that Powell can do is cut and be wrong because they were wrong the whole time. He has minimal credibility right now. He's not going to go to zero. They're taking a hard stance, and I just don't see cuts coming down the pipe in August after Jackson Hole, September or October, because if they get it wrong again, I think that that's a card that they will not play no matter what. They're going to do everything to protect that.
Okay.
Yeah, and like just to piggyback on that, like when you think about that, just psychologically speaking, right? If they're meeting and there's a sliver of doubt, what do you think they're going to do? Right? Like the safe play is just, hey, let's just wait it out another couple of months before we cut, because once we start cutting, we're going to be on a path towards cutting further. And the market is going to know that, right? And the other thing that I want to add is like they can't really signal to the market that they're going to start cutting, because immediately the market is going to preempt that and go on a bull run.
Do me a favor. Go to Trading Economics and bring up a 25-year chart of interest rates. because we all know that I'm not technologically savvy enough to do this and share it.
Yeah, without you leaving this stream.
And I am fully willing to admit that.
Yeah, you're gonna fucking exit the stream.
And then right after this, we are pivoting hard to why everyone is here, and that's Noto's amazing webcast, or with JP Morgan.
All right, so let's look at the past 25 years very quickly. The
Mhm.
past 3 times there was a top on inflation, they held for a little bit of time. I mean, I don't know what the last one is. Maybe it's 8 months or so. I didn't look before the podcast, but
It was 2018. 2018.
yeah. So
And by the way, the market thought we would get 5 rate hikes in 2019. That didn't happen.
So the chances of them just reversing course without even giving it time to see if what they did actually did beat back inflation, I don't think it's happening. And
Fair.
look, people do not take into consideration commodity prices nearly enough. You have to look at the oil markets. If oil starts going up again, they're not cutting. It's not going to happen.
And this is a daily chart. When was this posted?
This is trading economics. This has over 20 million data points that they track.
Yeah.
Okay, so
is
this-
1 year, then 5.
Okay, to May. Okay, perfect. Yeah.
Oh,
So-
so this is Volcker era, right, in the 80s,
Yeah.
and then we got 5% here.
So Amit, before we get off this, go to the homepage and click on commodities, and then on oil, see if you can get a chart of oil real quick. Brent or WTI, it doesn't really matter. Yeah, just do crude. Click on crude oil or Brent, either one. How far out can we go? Go 10 year. Real. Yeah, 25 is fine, whatever. Like you need oil to come down.
So oil, this is COVID. So this went down 10
Well, that's
years.
when it went negative.
It went negative, right?
Went negative for like 2 days.
So 2016 it was $30. 2020 it went negative for a couple of days, and then this is when it was crazy in June, 9% inflation.
That's when Russia invaded. That's February.
Russia invaded around. Yeah, you're right.
Well,
February.
there's a lot of things leading up to that. OPEC cut. There were a lot of things. But
Yeah.
go out to 25 years real quick.
What was this? What the fuck? Oh, 2008. All right. That was $138. So you're saying what? You think it needs to get to 60 for us to
60 is the sweet spot. Under 60 is amazing. Look, 60 keeps everything happy. The Saudis won't be happy because their economic budget is based off of around 80 on Brent. But at 60, oil companies make money. Manufacturers save money because input costs are a bit lower. Consumers do well because the input costs and manufacturing costs are down. Over 60 is asking for very bad things.
All right, we talked about the macro. We had our proverbial veggies. Can we now get to the dessert?
The meat.
yes.
Yeah,
All right.
sure.
So-
However you want to put it.
I guess let's start off with this. I'll let Tanner lead us off. But Tanner, Noto did a fireside chat with JP Morgan Chase. A lot of things were addressed. A lot of questions were there. I think we should take it one by one. What is the first thing you think we should talk about? And I guess which
I literally
which
think
of the topics do you want to start getting?
I literally think we should cover every single one. There's a lot of things. They're all very exciting. Steven said it. Tevis said it. Everyone said it. This was probably the most exciting chat that Anthony Noto has ever done. Fireside chat. He was spilling the beans. Okay, he was saying everything. It's giving us a lot of insight into their company, and yeah, I don't even know where to start.
Yeah, let me start like super high level, like before we actually even go into the contents of that JP Morgan fireside chat. I mentioned I think both Tanner and I released a video talking about the fireside chat, and I was realizing because Anthony Noto did 2 talks this past week. He did one with Mad Money with Jim Cramer on Tuesday, and for those who don't know, Anthony Noto and Jim Cramer go way back. I mean, they've known each other for a while, and Jim was sort of throwing him some very targeted softball is what it seemed like to me. These questions that, immediately addressed the $2.5 Wedbush price target. And then Anthony Noto got these questions again at the JP Morgan Fireside Chat just a couple of days later. And so I think that I mentioned that, a couple of people, retail investors on Twitter, myself included, were talking about SoFi, the company, the management team coming out and addressing this $2.5 price target, addressing the reasons why this David Cavarini from Wedbush put out this price target and trying to break down some of those bear cases. And I realized that, once I was doing that video for the JP Morgan Fireside Chat, this is the response. Like, they can schedule PRs, they can schedule, these talks, especially the one with Mad Money, like that wasn't really planned ahead of time. But I'm sure SoFi as a company has input in terms of the questions that they're asked. Maybe not all of them, but definitely a certain portion of them. Number one. And then number two, I'm sure that these were questions that were floating around in analysts and retail investors and institutional investors' minds alike, because they're question marks that need to be dispelled. And so this very much seemed like we all agreed, Anthony Noto was on fire. He was very prepared. It all seemed very deliberate in retrospect, because you had 2 appearances in 1 week where he was answering the same questions, stopping to explain them, spending a good amount of time on them, and really dispelling those bearish cases.
He's definitely a listener of the SoFi Weekly, is what you're saying.
I hope so. He
listens to all the points. He reacted to practically everything that we had a problem with, or any of the guests had a problem with. Yeah, it was great. One of the things that I thought was very cool is talking about deposits that were still growing. They're expected to do over $2 billion. They even said that on the earnings call. They're still holding up about 90% of deposits are coming from direct deposit users. This didn't come out of Anthony Noto's mouth, but still very exciting. Chris Patel is also going to be on that list as well. So he just signed up for direct deposit for SoFi. Last time he was on, he said it was going to be a problem to switch over his long relationship that he's had with TD. He made that jump. So obviously, we're winning over big skeptics here. One of the things that he did say that was also new, and then if you guys also have, we can just jump into the big ones, but I'm trying to keep all the big ones for later. We know we're all thinking of them. One of the more specific things, though, is he said a lot of the actual growth, what they're seeing in customers and everything like this, is actually coming from large institutions or large financial institutions, the Wells Fargos, the JP Morgans, the Bank of Americas, and didn't actually come from a lot of these, collapsing regionals, which is what a lot of people thought. Oh, this is just a short-term bump, due to the collapse. No, actually, he said it was quite rare. It's still coming from the big names, people that are making the jump, like Chris is. And 50% of SoFi accounts are still being transitioned over to direct deposit in the first 30 days. That we already knew. What we didn't know is that the entire time they had only benchmarked for 35%. So this is much higher than what they even expected. Anything else that you guys picked up on whenever we're talking about SoFi banking, either in what he spoke about with their financial services or lending? Let's keep it in that section first. We'll do it in sections.
I think the big thing, as you said, was this idea that they are not just getting a one-time bump from Silicon Valley Bank and FRC collapsing. A lot of this is happening more organically. I even started thinking more deeply today, could I get my money into a direct deposit with SoFi? I already have like the card that came in today, but I didn't get the $250 fee yet because I didn't set up the direct deposit. And I'm looking more deeply into it because I'm also thinking, like, why not? Why wouldn't I have it there instead of being at Bank of America? And I think there's, I was listening to the call just an hour ago, and one of the things he was saying about getting your money right, we already know this whole thesis of, you get the customer in, you're their mortgage, you're their student loans, you're all this stuff. I became even more bullish on it than ever, because if people are coming organically to this product, not just because bigger banks are collapsing, it means they're seeing it genuinely as the vision that they are portraying to shareholders, which is this one-stop shop for your finances. And I, as a shareholder and now as a user, I'm like, yeah, why wouldn't I just use this thing for everything? And then obviously the upsells throughout the course of my life will be high margin for them. So I thought that was one of the best things we got from the call before we get into the loans part.
Yeah. So the other interesting thing to hear about.
You're all
and
blown out leaning back like that.
Sorry, it dovetailed into the loans part. But yeah, so obviously the 2.7 billion in Q1 in terms of deposits, very little was from the blowback of SBV FRC, and more so came from the big banks. SoFi is on track for 2 billion, 715 FICO. I found a 715 FICO. Maybe I misheard it, but I think he said it multiple times. Like that sounded on the lower side of what we've had to expect, but I know that they have different FICOs for different lines for the bank.
Yeah, for which product? Because I have every FICO for every product. I didn't remember a 715 FICO.
So this is, maybe I misheard and it was 750, but this is what he was talking about with regards, like when he was talking about the bank, he was talking about the FICO scores. And this is when he went on the personal loan segment, talking about cash flow versus FICO, which we can get into that. But anyways, the other thing that I think was interesting for him to talk about was the goals that they have with regards to the business returns in terms of return on equity and return on invested capital. And when he addressed the capitalization problem head on with regards to the leverage ratio and the fact that they have ample amount of their own capital and funding capacity to carry on.
Yeah, so just to give some of the numbers, because maybe it'll help people for the FICO scores. For our SoFi Money product, it's 749 on average for SoFi Money. That's what makes the cross buy so great. Student loans this quarter was 769, home was 758, and personal was 747. Those are just the numbers for this quarter. And obviously it's a total. So even if we are going down, we're only going to see it marginally because the people that are coming on this quarter is only going to be a fraction of the total number. But I didn't hear that number. They did say though, they don't listen to FICOs like you said, but if you're under 680, it's a complete write-off. They don't do anything. They don't do anything for writing personal loans that are under 680, and then after that it's all about how much you bring in and how much you spend. And like I said in my video, products like SoFi Money and SoFi Relay, I was not a fan of SoFi Relay. Now I've come to realize that is going to be their biggest product. I guarantee it. Like end of this year it'll be their biggest product. And it almost is if people aren't looking at the numbers. It's the fastest growing product this quarter, and it'll blow past SoFi Money and SoFi Invest, because it's what allows them to get so much details to even, attract customers for other products. Like you can see what their spending is, if it's going through credit cards, any products that are, they're using savings accounts, high interest, if they have personal loans, if they have a mortgage, if they have a mortgage with TD, you can track that, see how much they're paying, when it's coming up for renewal, and then offer them a perfectly timed offering at just a lower amount to totally entice that customer. It's the perfect Costco chicken to get them through the door, With
regards to Relay, we've been mentioning it on the pod several times, how Relay is really the data play. And he literally said that on the JP Morgan call. He was asked about cross-selling at the very end by the audience. And even before that, when talking about Relay, he said, hey, look, this is growing really fast. But more importantly, we gather all of this data with regards to our users, and we leverage that data within our ecosystem. And that part there is a really important component to drive that flywheel of growth and the cross-selling even further. So Relay, while it might not seem like the biggest revenue driver, is really one of the biggest contributors of that flywheel.
Yeah. And it's even what they didn't talk about on the call, but it is great, is like they're doing auto tracking now where you can track all the prices of your cars and everything. I talked about this with Kyle, the stock goat. By the way, he said he absolutely watches every single SoFi Weekly. So if he's in the chat, I'd appreciate a comment. But he watches them all, and he would love to come on, just so then everyone knows. It's just a matter of his scheduling, but he's always invited. So just so everyone knows. But that being said, he said he tracks his car and everything through it, and the value of how that's trading on the markets. And I just think about what's happening with SoFi Travel, which they were talking about as being a very successful product even already. And then they want to get into event tickets, concerts, sports bookings, and match up with other partners and then sell those products through the bank. Obviously, SoFi will get an interchange rate for that, because if it's anything like the SoFi Travel partnership, you'll need the SoFi credit card in order to do it. So, it's very, very exciting. I think this is a new way of looking at it versus any other bank.
I think, and then we'll get Steve in on this. The cutoffs they have for loans, I think we knew they were pretty aggressive with it and fiscally responsible. I didn't know they were this responsible in terms of what they were describing for, like, either you got it or you don't got it, which was basically the sentiment I got from them.
And they tightened it this year.
Yes and no.
Okay, go ahead, Tevis.
Yeah, so well, yes and no, right? It's like, well, if you're under 680, then they cut it. But if you're over 680, then they'll look at your cash flow. They'll look at how much debt you have. They'll look at, how fiscally responsible are you as an individual, and then they'll make a judgment call off there. So it's a mix, it seems like, of very quantitative, where it's a binary yes/no decision based on that FICO, and then above that, what he was referring to as in that box above 680, then it's more qualitative decision where they can actually have all of your financial data and leverage that to then determine if they want you or not as a client.
But you would still agree it's pretty aggressive in terms of not letting anybody.
But yeah, absolutely. I mean, and like that's one of the value propositions, right?
Yeah,
like I want this lender to be very exclusive on the high end.
100%.
Steve, can you throw up? Okay, sorry. If just whenever we want to move on, can you throw up the comment by Blue Collar Kid, because I think that this is another point that was brought up in the JP Morgan chat. But Steven, by all means, go first.
Bring it up.
Let me give a shout out to some people in the chat. We have Michael Wilder here. Hello, Michael. We have Chris. SoFi equals lifestyle brand. So he's getting a little bit more bullish on SoFi. He said, I'm sure they'll eventually do SoFi Black Card for premium members. That would be super interesting. And which is the comment you said, Luke?
Blue Collar Kid.
Oh, Blue Collar Kid. Okay. Where is the blue collared?
Oh, it's all the way up. Near Crypto 411.
Okay, that's Adam. I know Adam. Blue Collared Kid. Blue Collared Kid. I do not see it.
Okay, I can also just read it.
Yeah, read it. Oh, I got it. Okay. First time watching you guys live. People seem to think it's a bad thing SoFi hasn't sold their loans. They are bringing in 6.5% of those loans compared to 5% selling them. So yeah, maybe we should transition to the selling versus holding the loans on the books. Steve, do you want to take this one first, or?
Okay. Well, I'm glad we're going to discuss this, because I'm going to call somebody out, not by name, because I don't know their real name. And look, when I write articles on Seeking Alpha, they're my personal opinion. And
you can drop this now.
When people make comments that don't have their real name, I don't take them seriously. I'm not.
Is it IP banking?
I'm not hiding. I'm right here. So the fact that
New York. Are you getting into internet beef with some Sammy Pants 45? You're doing this right now?
Your New Yorker is coming out.
Yeah.
Forget about it.
It's like, bro, if you got a fucking problem, we can take this outside, okay?
Look, it is annoying when people flat out think the commentary by the CEO and the CFO of the company is 100% incorrect, and that is their opinion, and they think that they are 100% correct in that. They think that these guys are out here lying. Look.
Okay, wait, now I don't know who you're talking about.
And I'm not going to, you can go through the comments and figure it out. But if that person's watching, message me on Seeking Alpha. And
Steven's like, if that person's watching, fuck you.
No. I made a statement that I think SoFi is going to be at $10 by the end of the year. I don't know what it's going to be. It may very well may not be. I could be wrong. But we can do something for charity where I put up money and you put up money. And winner, the money goes to their charity of their choice. Message me, 100% willing to do it. No problem.
I'll pitch in on that
so much.
If
I
you
love
put
him
a
so
comment
much.
on Steven's shit, just know he's gonna read that shit.
Well, no, I'm not responding on Seeking Alpha. I actually chose not to respond to anybody this time because I'm gonna get too angry at it. And
Guys, if anyone wants to see that comment, you'll need a premium membership. Go check out my link down in the description down below. Okay.
Or just go to
I was
incognito
waiting
mode
for
and
him to
get all
plug
the
it.
articles for free.
So, look, Anthony Noto, this is not the first time that he has explained why they are not selling loans. It is their job is a stewardship of capital and to generate shareholder value. They feel they can generate more shareholder value by holding the loans for investment rather than going to the market and selling. It creates an extra 2%, drives net investment income. I'm not going to argue with their actuarial models that have actually been very, very tight. And they are well under their accepted risk level. Now, as a shareholder of the company, if I wasn't comfortable with the models that they have projected and what they have told the shareholders, I would not be a shareholder. But I am taking what they're saying and putting in the 10Ks and going on the record saying is face value. Do I have any knowledge that it is true or untrue? No. I can only go by what they're saying. So for people to come out here and say that the CEO and the CFO is straight up lying is ridiculous.
But that's the thing, though, Stephen. Like the bear cases, as more time goes, they either get way more far fetched, or it's completely, grasping at straws. Whereas maybe 18 months ago, a lot of them were legitimate concerns, and management has consistently and aggressively been addressing all of the different bear cases with their actions every single quarter, in and out. And at this point, there's people straight out saying, oh, it must be fraud, because it's just an inability to comprehend the fact that, these bear cases are actually deconstructed on a fundamental level. And the company is actually, doing some of these decisions with forethought as opposed to just haphazardly, right?
Yeah. There are companies that sell loans and there are companies that hold them for investment. SoFi is well capitalized. They are holding them for investment. There's nothing illegal about that.
Can we explain why they're holding them for investment? So we get that it's not illegal, but what is the logic Noto gave for why this is a better return on their money?
Because they can sell them at the market for 4%, or they can hold them and make 6%. So for them, it makes more sense to hold them because that is reoccurring net investment income that they don't have to reestablish quarter over quarter.
Why are they getting the 6% versus 4%?
The rates are expected to go down.
Well, and also, yeah, if you're going to sell a loan that's already matured a little bit and you don't know what the market's going to come forward, that people are going to have to pay, or people want a premium on that loan in order for them to take it. And there's also an opportunity for default, and that is, so the premium will go down because people need to take on some sort of risk, or people are taking on some sort of risk.
Cool. So I mean that I think that appeased a lot of shareholders, right? That was one of the biggest things Chris was worried about, and so that that got a lot of people thinking that this is okay.
The best way that it was put, at least recently that I read, was from IP Banking Research. Now, I don't agree with this guy 100% all the time, guy, girl, whatever, but he does understand banking, and what he sort of said was there's two different ways that they can do this, right? They can either do the fair value accounting, and then we get to see as all the money sort of ticks off the loan. Anthony Noto sort of said this during the call. He said the way that they actually look at their delinquent loans is that after 10 days, they have to mark down the loan by 35%. After 30 days, they mark it down by 70%. After 90 days, after 90 days by 90%. After 120 days, the loan is done. Okay. Whereas the other banks, it's not that they just simply don't do that. What they do is they mark it off before the loan even starts. That's what the CECL reserves are. So the CECL reserves. So once they actually get the CECL reserve, sorry?
You can throw it up on screen. I put it in the private chat. Go ahead.
Yeah.
Sorry, continue, Tannor.
Yeah, perfect. But that being said, banks already do this on whenever they actually do take the loans, and then they actually market between around 7 to 8% right now, very similarly to what SoFi is expecting. It's just a matter of whether you're going to do that before you take the loan or after. Now, the amazing thing that I like and that wasn't brought up is that it's still easy to hide your problems behind door number one of what the original banks are doing, what IP banking research sort of pointed out, where if it does get worse than 7 to 8%, no one needs to know because you're supposedly holding the loans till maturity. So you don't need to actually mark to market those loans. Okay. So you can actually wait until a forcible sell because, people are actually leaving the bank. That's what happened with Silicon Valley Bank, right? And then once they actually had to sell a large chunk of their actual, their assets, then we got to see that they were not marked anywhere near where they should be. And there was massive problems. Okay. That will never happen in SoFi's case because we will see the house collapse as it's actually going on. You'll be able to see the red flags as they appear. So it's actually a large benefit to SoFi, in my opinion, but some people say it's actually not that big of a benefit if you already mark it off to begin with.
Steve, or Tevis, go ahead.
Tevis,
Sorry, I was just going to say that I think that's also a good segue into the segment, which they dedicated a good portion of the talk to on fair value accounting, as to why SoFi, does that, what are the benefits of that, and what that allows for them. I can put this up on the screen.
Is it your
Brad?
tweet?
No,
Okay.
it's a new thing that Brad did a good summary of it on what Noto said on fair value accounting, basically saying that it's more transparent.
Tevis, before you go, this is basically what the Wedbush analyst had an issue with, correct? That they were kind of using loopholes in terms of how they were doing accounting.
So no, the Wedbush analyst by and large was comparing SoFi a lot to lending clubs models, and I think that's one of the main things that people took issue with.
Okay.
So I actually have two of his quotes up. First quote was, "We fear that if SoFi were to sell loans, it may not achieve the same level of gain on sale margins that were generating Q3 and Q4 of 104 cents on the dollar." Second quote was, "We expect regulatory scrutiny on capital ratios and stress testing to intensify."
Okay. Tevis, you can keep going with the fair value stuff.
Yeah. So basically, there's two sort of distinct methods of valuing assets and liabilities. At cost, records them at their original cost, or the price paid to acquire the asset at the time of purchase. Whereas fair value is the price that it would be received to sell an asset or pay to transfer a liability. Given its fair value in the market. And SoFi does this fair value accounting. And basically, Brad here has highlighted a couple of the benefits that come along with that. More transparent in terms of the quarterly markings, which account for economic conditions, including loss assumptions, which Tannor was also just talking about, these markdowns in terms of if something is 60 days delinquent, that's what we assume that markdown as a company, and then if that account is resolved and it's fine, then that's great. If it's not, then we've already made that assumption in our financial statements, and it's reflected more frequently in terms of their quarterly results. So number two is a marking boost. A fair value marking boost last quarter was despite loss rate rises from 2.97% to over 4.5%. They talked about this as well, the 3% sort of charges where they have the capacity to go to 7 or 8%. That's their threshold, and they're well beneath that threshold right now. And then the second part of it was talking about this transition between fair value or held for sale versus held for maturity. But yeah, so overall, this is a good summary of that segment and what Noto was saying on the fair value. Anything to add there, Tannor or Stephen?
No, I think that was a good touch on it, and we might even see someone pop in to give probably a deeper explanation on the banking side of things. So I personally vote to move on.
Okay. Do you want to move on to Technisys?
We could. Just really quick, though, I just wanted to drop one more thing on the banking stuff, actually, two. So one, he said that Wyndham Capital Technology is already starting to get ready and is going to start allowing them to start scaling home loans again. Very, very exciting. We haven't seen that happen since Q2 of 2022. So practically a year off from home loans. But that being said, checking and savings, checking and savings, the SoFi Money product is still seeing extremely high buy rates, is what he brung out. And that without it, just looking at a simple lending customer that doesn't have a relationship with SoFi Money, they were really paying a customer acquisition cost of around $700. He said $700 to $800 per person. Okay. So absolutely incredible. With the SoFi Money product or person, right, that actually ends up getting, a SoFi Money loan, they're paying a little around $300 to $320 per person. That being said, you save a heck of a lot more per person. Not only are they in for multiple products, so that also helps, but all that extra cost savings goes to the profitability of the loan. So, guys, just time is all SoFi needs. If they survive this bad time, which forever and a day they have been, right? The student loan moratorium has been extended 7 different times. And the bears are waiting and the bears are waiting. But really, the longer you actually hold this product, in my opinion, is the way that Warren Buffett would like to look at it, the less risky it actually gets. We're getting stronger, not weaker here.
One other thing is the 70% of people that we reject from loans. I didn't know this. There is a affiliate marketing program we have where we send them to other people and we get a commission. And I learned this in the call, and I was like, "That's great. That's phenomenal."
Yeah, we have a partnership with Pagaya that actually refers loans to other people. Kyle, from the Stocko YouTube channel, actually got rejected from a personal loan. Right. He had a 800 some odd credit score, but it wasn't about that. It was about his cash flow. I guess he kept just too little money in his bank. They didn't like it. So they said, you know what?
He was also self-employed. Like, he was a business. So there's also that the frequency of that cash flow as well.
Right. His pays are infrequent. That would make sense as well. But then they said, okay, not a problem. We can still service this loan through SoFi, but your loan will actually be owned by Upstart. And then actually got an Upstart deal, which he still didn't take. So that being said, and I think they offered him at like 15%, the Upstart loan. But still, funny how that all works. I'm now ready to move on to the tech platform. Chris got rejected as well. Chris Patel.
Yeah. And Chris sent like a mediocre application, but that goes to show that like it's good that they're rejecting mediocre applications. Right?
Honestly, that's probably like one of the factors that got Chris involved in the stock. The fact that he got rejected, he's like, okay, like these guys must be like really scrutinous.
Yeah, right.
I want to be invested in them. Yeah.
Okay,
cool. Yeah.
Do you want me to say some points from the tech platform, or?
Yeah,
go for it.
We've already assumed that Galileo and Technisys were going to be a massive benefit when put together. But now he sort of talked about how it already is. So they weren't in talks with any large banks before because Galileo just wasn't the service that they were looking for exclusively. But now he said they're in with over a dozen plus large institutions that are facing, I forget his exact wording, but it was something along the lines of like industry destroying risks that they need to now modernize, right?
And end of life technology was the term that he used.
End of life technology. Perfect. Yeah. So one of the things that he did say about this is that, yes, this is obviously great. We're in talks. They've even said they're already in the proof of concept with a really large U.S. financial institution. They said that on the earnings call. But they did say it's going to be moderate growth in the tech platforms for a little bit, as whenever these new platforms actually do switch over, or these new institutions do switch over, they only start to bring over their new customers, which, as we know, those even if the largest banks don't acquire customers at a very fast rate. So they are still only going to bring on so many customers over time. And then once they actually see that this is a true product, they know how to use it, then they will start to pour over their old large, cohorts of customers. That's when the real money will come. So they still said, expect for probably the next 3 quarters for it to be moderate growth.
Yeah, they were saying it was going to ramp up towards the back half of the year, towards double digit, the 20% plus margins that we've been used to on the tech platform prior to Q4. One of the other things that was interesting on the tech platform, he again mentioned Silicon Valley Bank and First Republic, and he was saying that a lot of these regional banks that collapsed, they didn't have real-time asset and liability management, whereas SoFi, as a result of their tech platform, has this technology embedded where they can see deposits in real time, by the minute, split up by different segments. My light just crapped out, where they can actually have a much more comprehensive view of what's going on in real time on the bank side, which is obviously a testament to their tech platform, and it's something that they can, sell as like a white label point to other institutions as well. Like, hey, all of a sudden now you can have real-time in-depth analytics split out by your cohorts. Yeah.
Are we going to skip past the idea that Tevis with the light off just looks like he's in an orange jumpsuit and barred windows? Like, what are we?
No. That's facts.
Fair enough. It's one of these like little portable lights that I had in its battery run, and yeah.
He snuck in a little prison cell phone to do the SoFi Weekly.
Steven, your thoughts on the tech side, AWS, the fintech side of SoFi that Noto talked about?
Yeah, so we've discussed this a lot over the past several episodes, or going pretty far back. I've put in my articles when I discuss the tech side a specific link because it's really important, because from this institution, they reported that approximately 80% of financial institutions run core banking systems they built themselves, which means much of the architecture was designed in the pre-internet era for physical branch banking. Now, anybody who has done any work in SQL systems or run any type of programs that were built in-house, they continue to have to make Band-Aids and Band-Aids and Band-Aids and utilize different APIs, and it is a headache to keep it up with evolving technology. Eventually, you will need to rip and replace, because banking today is not the way banking used to be. It is much different, and the legacy systems are not going to be able to handle what the customer demands in the future. And we don't have to spend a tremendous amount of time on that. But when you think about the banking industry, it's not going away. Like every economy worldwide needs a strong banking system. And when you think about customer demands of the 1980s and the 1990s, there were not smartphones. You had to go to a physical bank. You could not deposit a check by taking a picture of it. Back then, you couldn't even go to an ATM and withdraw money. I mean, it was going to a physical branch. Branches were busy all the time. Skip to 2023, most people, I would think, are utilizing a smartphone to do a majority of their banking. Also, think about what it was like closing an account and reopening an account versus today. The technology side of a lot of banks has to change, and probably has been going through serious upgrades. And the fact that in a matter of weeks, it's gone from, we're in proof of concept with one large financial institution to we're in talks with 12 large financial institutions is very promising. Here's the thing, if we don't hit on any of those 12, I'll be worried. That's when I'll start to worry. But the fact that we are in talks with 12 now, I think it's only going to get bigger, and we just need one to undertake this platform, get some good press on it, just like happened with Palantir. You start getting, hey, there he is. Hey, Chris. You
Hey,
got
guys.
the guy from Jacobs going on TV. A lot of people saw the interview talking about Palantir's data sets and what it did for the company. You get BP putting in their actual earnings call and discussing how much it has reduced their gathering costs. And then Tyson Foods coming out showing how much it has reduced their production costs on each silo. If we just get one of those or two of those, you could see more and more and more. And the question that I always think about is, what companies have the entire back end to build this product? I'm not coming up with any. There are companies that have parts of it, but I don't know any companies, and I've done a lot of research on it trying to find it. I don't know any that can do everything that Sofi can do on the back end. So this could be absolutely huge in the future and pay off reoccurring revenue in spades. And what's it worth if Sofi ends up being a winner take most company, actually supporting and underpinning a large portion of the financial system?
Can I back that up, what you just said there on the tech platform? Noto also said on the webcast, he said, the tech platform pipeline has been the strongest they have ever seen since he's been at the company. And the TCV, the total contractual value, is also the highest Anthony Noto has ever seen.
And it could continue to grow. It's in its infancy. And I would love to get somebody who works in banking on, and I don't know if they can talk about what they've seen, because I only know what I've read from doing the research. I'm not in banking, so I can't speak about it versus anything outside of the due diligence that I've done for myself. But I would love to know if the research that I'm reading is accurate, because if there is, in the next 10 years, you would think that all the regionals, thrifts, communities, and even large money centers are going to have to upgrade, and this could be a huge opportunity.
So one thing, I guess, on this whole, some of the Galileo employees, so Derek White, the CEO of Galileo, and at least one other, have gone on podcasts in the past. And they've talked about how in the entire banking sector, that there's one technology that a significant amount of the legacy institutions use that is going to be, what was the term he used, Tevis, in the actual thing? It was end of line or end of
life technology.
End of life. That's right. So end of life technology. And they've said specifically that there's one core technology that's going to be going offline in the next few years, and that all of those systems are going to have to be replaced. And so, I mean, if they know what that technology is, and if they know who's using it, I am sure that they are pushing really, really hard on those particular institutions, right? That they know have deprecated systems that are going to be phased out in the next few years. And so in addition to everything else, I just thought I'd point that out. That's another data point that we've actually heard from management, that they've said these things are going away and they're going to need to be replaced. And we have, they're in discussions with more than a dozen companies. So,
Tevis, is it the I know that you've touched on this. I'm not sure how to even say it because I don't know about it. But is it the COBOL thing that Doug has said?
Yeah.
Is this what they're talking about?
So COBOL is a development language that was started in the late 60s. That's what the entire banking industry is. That's what money is.
That or Fortran.
Yeah, exactly. It's okay. It's like we're writing, I don't know, Stephen King novels in Latin.
Let me give you an example.
That's the equivalent. Go ahead.
So one of the more useful pieces of chemical engineering software that you use is called Aspen Plus. It's built in Fortran, like back in the 70s, and then they keep doing Band-Aid fixes. It is so frustrating to use. I use it every day. But here's an example of what Tevis was talking about. I cannot open a file that has a file path that is longer than 136 characters, because it's built in this old technology. Like, so I have to copy, like if we're trying to do something on the cloud, the file path is always too long. And so I have to copy it like to my C drive and then open it from there and then work on it. And it also makes it so, here's another point, you cannot have any cloud synced files or it corrupts the files immediately. So as you're working on it, you'll get a corrupted file and then it will no longer work. So I have to keep everything on my own hard drive, and then we upload them to the cloud, and then we have to download them from the cloud again in order to make it work. So it's stuff like that, right? That like it makes everything harder, it makes everything more expensive, it makes it so that we spend so much time just troubleshooting the program rather than actually doing our job, but there is no Galileo and Technisys in this case. That there's no software that is as powerful and does what I need it to do. And so we're left with this deprecated
Is
old
this the language
crappy
that's going
software.
offline?
No, it's
So
not
it's not the
necessarily the
language.
language. Yeah,
Go ahead, Tevis.
Yeah, so it's not necessarily the language. It's just that they have to rewrite their applications onto another language that's more flexible, more comprehensive. The
Right.
language is still going to exist. It's a language, right?
Yeah.
Or they just plug into Galileo and have everything out of the box. So, I mean, but this is, I
I'm
think,
just
an
wondering,
important point.
Because you said
Yeah, go
something
ahead.
was going offline, or that they're not going to be using it. I mean, is it a regulatory reason why they're not allowed to use this, or
So
why would
I
they be forced to
believe-
change?
Yeah, I could be wrong, but I know Riley was talking about it several weeklies ago, where banks are, it is regulatory. Like banks are required to maintain certain standards, and there's a time frame, like a deadline, essentially, from where they need to be and what the threshold is on because the problem is, as a lot of these things get outdated. Right, if COBOL is from the late 60s, you can count on one hand the developers who are actually proficient in this. No new developer is learning COBOL, and so it's increasingly more and more difficult for a lot of these places to find actual competent developers to patch these fixes up. First of all, second of all, it's so risky to keep it on this like legacy infrastructure, and third, to Chris's point, I think one of the interesting, like maybe lesser talked about benefits of moving is what it can provide to the end user. Because I mean, people tune out the moment you start talking about like application interfaces and coding languages. But just that example that Chris brought up is a limitation of that legacy language. If you go from COBOL to Python, which is like what most backend systems are built that are best in class today, because it's super flexible and easy to understand, and like it's like the most popular coding language on the back end. Every developer can code in Python, today versus COBOL. So all of a sudden you unlock an entire pool of new devs. It's much more flexible. It's much more responsive, and the end user benefits are so much greater, so that you all of a sudden get these wins on all of these different levels, from the actual maintenance of the infrastructure, from like bugs and developer tasks, all the way down to the end user. And so that's number one. And number two, there's much less risk of downtime. There's much less risk of data corruption. There's much less risk of so many of these different aspects. Number two, and then number three, with Galileo's out of the box components, you could just plug and play because everything speaks to each other, right? They're all plug and play components. It's not this giant monolithic structure where everything is so interconnected that if you want to like pull one little lever, you can risk bringing the entire system down. It's all microserviced out. It's all in different pods, and that controls for risk as well. So it's just a no-brainer on so many different levels, and I'm so glad that a lot of these banks have to change, not necessarily for the individual names themselves, but more so as a system as a whole. The
Right.
level of risk is insane.
So I think that wraps that up. I think we should talk about the two last and probably biggest points, or not biggest points, but definitely the most clickbaity points that people touched on in the long-term future, and look at this stock for a story stock as a moment, and then we'll go back around to fair value accounting before Chris explodes, and we don't want that. So he's going to want to talk about it. We'll let him talk about it. So the first one, Anthony Noto said that I think it was by 2025, he sees members growing to about 800 to 1 million new members per quarter. What did you guys think?
So he said by 2024 he expects it to double, if not even reach 1 million. So that
By 2024?
So and where he put in 2025, and I could be wrong, but I think this is correct. He said if we can hit those member growth numbers, I wouldn't be surprised that by 2025, 2026 we'd have 20 million members, and then we can start vying for a top 10 spot in terms of global financial institutions.
I mean, what do you think, man?
I thought it was pretty cool. I mean, if you average out the numbers, I don't know if it was one of your guys' tweets or someone else on Twitter, but that would mean 31 million members by 2030, which is pretty insane. If they actually get to those, sorry, my phone hit something. If they actually get to those rates of 8 million or 1 million a quarter. The other thing that was interesting to me about this is that that means they believe that the organic marketing they're doing is going to be enough to be able to attract that many more millions of people, which means, I mean, I don't know if they have to buy another stadium, but they're probably gonna have to do a lot more stuff on the marketing spend. I don't know what exactly that's going to be. But if they think, like, I guess here's a question to the crowd. What do you think was the reason they believe there was going to be that inflection rate of growth? Because outside of increased spend in marketing, how do you get to 1 million members a quarter?
You get there by a lot of people liking the product, word of mouth, and recommending it to their friends and family.
Yeah, but 1 million, doubling that per quarter. I mean, you think that's all
Dude,
purely organic, or?
Think
They're
about the stats
artificial-
that have gone off
they're-
about millennials and the younger generation. How many of them are going into the job market?
Yes, but the attention, getting their attention is harder than ever. That's why they bought a fucking
look,
stadium.
so the macro trends are the macro trends. They're going to be there in terms of like generational demographic shifts. Don't forget, SoFi is handicapping their own numbers right now. They're lowering sales and marketing spend. They're being really selective around the FICOs. The moment that the Fed starts lowering rates and it gets a little bit less precarious on the macro level, SoFi is they have the ability to open the floodgates and even let more people in, because they're not going to be as scrutinous over the FICOs, because there's a lower risk overall of just generally defaults and things breaking around in the banking industry.
And also, this is something that Carlos and Vitali bring up, right, a lot of times, is that humans are really, really bad at understanding exponential growth, right? So how much easier is it if you start to rely mostly on referrals? Right now, we've got 5 million members, right? We're getting, 2 years ago, it was at 3 million or 2 million members, right? So just the referrals, you get, twice as many referrals from 5 million as you do from 2.5 or 2.5 million, right? And so it starts to build on itself, and you get this nice exponential growth. But as a percentage, it's still lower, right? So we had quarters where we were growing something like 18% quarter over quarter, right? And 18% quarter over quarter right now would be almost 1 million members, because we're above 5 million members. And so, well, obviously, like the rate is going down, right? We're not going to get 18% growth quarter over quarter. But if you stay at 9 and 8 and 7, once you're at 20 million, if you only have 5% growth, that's still 1 million members a quarter.
So there's a problem with that, though. Is that it's
you run out of people?
Well, no, not running out of people, but it's that we also don't track monthly active users. We don't know what the user base of SoFi is.
Yeah, and that's true.
How it's growing.
And let's touch on running out of people. You'll never run out of people.
I know.
Why? Because everybody continues to have babies. That means more people that are going to need bank accounts in the future.
Not if
Yeah,
Greta
most people
Thunberg
are.
takes over the world.
So hold on. You don't even need to account for like population expansion, because in that same breath, Anthony Noto was talking about global expansion.
Hit the second
This was
point.
my favorite point.
That is
Yeah,
true.
Go
okay,
ahead.
go, take it.
Oh, okay. Global expansion for SoFi in the long run.
He is so happy. Oh my God.
Me?
You haven't been this happy the whole time.
Well, because he
Finally has a real competitor to Nubank.
Yeah, no, it very specifically said LATAM. Okay. I think that they already have such a strong presence in there with Galileo and Technis, is what they said. It's just funny because it has nothing to do with how their actions have actually been, right? They were Hong Kong, and then their Bender 9000 found things that
United Arab Emirates.
Yeah, United Arab Emirates and Singapore. So nowhere near LATAM, but the fact that they want to come there is so crazy. And that just shows me being a new bank lover, just how large the total addressable market is. And even Anthony Noto sees it. It's just back up the truck, guys. Get in the van. We're going shopping. Like, I'm buying more
right now.
Sorry?
It's a big opportunity. Think about how much money is going over to Dubai right now. It's a huge deal.
Yeah, they're calling Dubai the next Silicon Valley.
Yep.
Chris, what else stood out to you in the call? I mean, I know you came a little late. Anything really major stood out to you from the fireside?
So I think the one thing that you guys haven't talked about yet is they actually talked about cross-buy, and they gave, I don't have the numbers in front of me, but they actually gave details. The only one that I remember is they said that like 25% of their personal loans or of their loans come from existing members. It was more than that on mortgages, but they talked about invest cross-sell. It was something like 70% of members are from, of invest products are from cross sell, and they actually broke out those numbers, which was really interesting, which was something that they'd never done before. So I like that. Again, I'm a numbers geek, so that sort of stuff, and most of the other stuff you guys have already covered. Sorry, I'm kind of shaky. I'm on my phone.
No, you're good. As a shareholder, did you feel like any potential inkling of a bear case you had, or just question or concern, was kind of put to bed as Noto was speaking at that fireside chat? Not that there isn't a bear case, but that
so many
I think the tech platform was the one that I was most worried about, honestly. And it's still going to be longer sales cycles, but just the way that he was speaking about it more than anything else is the important part to me. That like I want the tech platform to become what we all think it can, and the fact that it declined quarter over quarter, and more than that. So I mean, I understand if your second largest client leaves, right, it's going to hurt. But more than that, the fact that it had been flat for 3 quarters in a row, and then it went down, right? So it wasn't just that it was like one quarter where you lost a big client. It was also the fact that like revenue had significantly decelerated, and there were these mitigating factors and everything. But you want to see, and honestly, even with the way that he talked about it, these longer sales cycles, the fact that they're going to be bringing on people, only new accounts, and then slowly, bringing over the legacy accounts, means that we probably won't know until 2024, even mid 2024. How this all plays out. But the way that he's talking about it, the additional detail was really important for me to hear. I think more than anything else in the fireside chat. I do enough deep diving that like all the fair value stuff and everything else wasn't really news to me. But the tech platform is the thing that I worry a lot about, or that I was worried a lot about, and that did ease my fears there.
Yeah, you can't really read about their pipeline or total contractual value anywhere. So,
and there's so little in the 10Q about the tech platform. There's like 3 numbers, and that's it.
Sofi,
it's not that little, but right, but it's not a lot.
Sofi itself also started implementing 2 of their products, the payment risk platform as well as Connecta, which was quite interesting. He also spoke a lot about it. I don't have all the points here, but just all the things that it's already starting to do: reduce the cost per contact, increase customer satisfaction. There's a whole list of things that they're already seeing benefits for at Sofi themselves. Just issuing out a lot of those very, very easy calls or customer contacts that they might have seen before can just easily be done on AI. It might as well just be a chat GPT of a frequently asked questions, if that makes sense.
Yeah, so one extra thing I'll sort of piggyback on that point, Tannor. When everybody thinks about AI, they think about the B2C applications with regards to the chatbot. But, Anthony Noto was also touching on what it can provide them from an anti-money laundering perspective. From a B2B perspective, like a lot of banks are, from a regulatory point of view and from like a overall cleanliness point of view, really interested in the anti-money laundering section. They sink a lot of money into that. And if they can automate a lot of that with AI, whether it be Connecta or something in the wider Galileo ecosystem, it's just another value proposition for having this all plug and play tech solution, right?
And it goes past that. It's if they can make the compliance aspect easier and more frictionless, what's that worth to companies?
100%.
So Steve, are you a Sofi member?
So
do you use them?
Yes, but I do not do my personal banking there.
Okay. And Amit, you use it, right? At least somewhat. So
I
have
use,
you?
the problem
Go
is
ahead.
I have a business bank account, and that's the only reason I haven't transferred a lot of money, like direct deposits there. But I just got the card today. So I've been using it.
So I haven't noticed anything because they said that they're using Connecta. I haven't noticed any difference in their customer service. Like it's still the same kind of prompts, and basically everything leads you to a customer service rep if you have anything that isn't just like kind of basic. I
Could be
don't
slow
know,
rollout.
and maybe it's a slow rollout or something, right? I'm just saying my own personal experience is that I haven't noticed, and I've used them as my primary bank since like January 2020, right? So, but I haven't noticed a real difference in their customer service. Just I wonder if others have because they say they're using it, but if they are using it and it's supposed to be different and it's not different, that's probably not a good thing. So we'll see.
Have you ever used their customer service, and is it just on the
Yeah,
phone?
I've used it a bunch of times. No, I like the chat because I hate talking on the phone. It's like my least favorite thing in the world. So
Okay.
I have had to call. There was one thing, I think when we were closing on a house and I had to wire money. I think I had to talk to him over the phone. But the live chat's really, really responsive. One of the bear cases that I don't have an answer for though is it seems like that when your account gets frozen, which typically happens because of some sort of kind of weird check or something. Like most people who post on the Reddit about this, like they don't always tell the whole story. It seems like, and then eventually, like through the comments, you kind of figure out that they were doing something, maybe that caused it. But I guess a bigger issue is just that then they can't seem to get to the fraud department to get their money unfrozen, and sometimes it'll take weeks, right? And that's not okay. Like that needs to change. Even if that happens once, right? Like if you got a check that bounced or whatever, and they think might be fraudulent, and you get your account frozen, you should still be able to talk to somebody about that within a day or two. I think.
Sorry, look at Steven's shifty little eyes as his alarm goes off. And this,
I had to mute him just now. I just realized I was.
yeah, just go to your front door, man. If someone's there, just go see.
Oh, that was me.
No, you muted him.
What
that
are you
was
talking
you,
about?
Chris?
You went off.
Yeah.
Oh, that was Chris. That was. Oh wow.
I'm just watching Steve go.
Oh, you know why? Because I'm
Why?
farming right now.
What's farming?
Dude. He's playing
Bitcoin
World of Warcraft.
farming?
Who's playing World of Warcraft?
Oh,
That's why we lost him halfway through. I was
my
like, Steve
God.
hasn't said anything in a while.
No, I was listening to you guys. I was learning from you guys.
This guy, I love it. I love it. That's awesome. So, Chris, Sofi to $20 by the end of the year, end of next
No.
year. What do we? I
Not the
heard.
end of this
Okay,
year.
hold on. You tweeted something today. Okay, there's this guy who bought a bunch of out the money calls, $15 leaps, and you said that's too ambitious. You don't think it could be 15 by Jan 2025?
I think it could be, but like,
Why is it too ambitious?
I mean, that's because markets, you can't guarantee anything, right? Like, and the other thing is that like I had out of the money leaps that were way up and then ended up expiring completely worthless, right? Because of the drawdown. They expired worthless this year in 2023. And so like, I don't know, like a triple in a year and a half, like, yeah, it's possible, but a lot of that probably depends on the macro.
Didn't we get the decline already from 21 to 470? And isn't it time to kind of like?
No, I think definitely. If you look at the numbers and you try to look at even like a forward PE ratio and everything, I think it's doable, right? Like I think that $15 is definitely doable. But if you're going to buy leaps, like doing it where the stock has to triple to get you in the money. Now he then talked about how he never holds to maturity, right? So he's just capitalizing on, and right now IV is actually really low. So if you're going to do it right now, it's a good time. It's got low IV. If you get a little bit of movement in the stock price, but you've got like a run up to earnings and the IV goes up, then he can make bank even long before it expires and just sell it ahead of time. So I was just curious more on what his thought process was, and how he trades in and out more than like, yeah, $15 is doable. Like $20 is totally doable by 2025. 2025. A lot of that depends on the macro, and a lot of it probably depends on the tech platform. And the part of it that depends on the macro, I think the most, is whether or not we're able to sell the loans. right? It's because SoFi's growth, I think the biggest thing on the lending side that I'm worried about is if we do start hitting our capital ratios, kind of the lower end of those, and we can't continue to grow the loan book, and there's still no demand for loans, it means that the growth will slow down. I don't think SoFi is at risk of like losing money. Not that they're at risk of like high delinquencies derailing the entire company and everything goes to zero and they're going bankrupt. They're just too well run for that, and their underwriting is too tight. But there is a risk that like you get down to 10, 15% growth because you just can't originate more loans because you can't get them off your books and you've hit your capital ratio constraints. To me, that's the bigger deal, and that's what would possibly lead to slowing growth. And if you've got a growth company that's only growing at 10%, then the stock price is going to reflect that, right?
We still have a pretty long ways to go though for ratios.
We do. Well, probably only another couple quarters. So I mean, I ran the numbers, and in the banking, or in the total thing, we're at like 17, 18% capital ratios, and we could probably carry another 5 to 6 billion and still be around 14%, which is probably where we want to be at about long term. So that's only, we held 3 billion extra loans last quarter, personal loans. Yeah. And so if you do that for 2 more quarters and you're pretty much at your limit if you don't sell at all.
Yeah. If we don't sell or, grow our actual, what do you call it? Our capital,
Well, but then you'd have to dilute, right? The only way to grow capital would be to either through debt or through equity. And so you're looking at dilution at that point. And I don't want more dilution. Yeah, I don't know if you guys are.
Unless we're profitable.
But yeah, so that's the big deal. And I've been thinking about this more recently. GAAP profitability is important for investors right now because it's in vogue to, look at Palantir. Right. Yeah. Interest rates are high. People want profits now. They don't want growth later, earn profits later. So that's important. But actually, it's like my personal investing philosophy is that it's not like I'm invested in companies that are growing at a very fast clip and will eventually be profitable. And I'm okay with sacrificing a quarter or two of profitability for additional growth that pays off down the line. Like that's me personally in my investment style. But SoFi is a different beast because of the reason that Tannor just said. So one way to increase the amount of capital you have is GAAP profitability. So you have retained earnings that allow you to just increase the capital, right? And so for SoFi, it's actually really important that they get GAAP profitable, not just because investors and analysts will think, yeah, that's super cool. It's important because at that point, like if you're bringing in $100 million in GAAP profitability every quarter, what that means is that you can originate an additional something like $700 million because your capital, if you assume like a 14% capital ratio, right? So if you have if you've got $100 billion and you're at your limit, but you make $100 million in a quarter, the next quarter you can grow your loan book to 10.7 billion, right? And so it allows you to continue to grow that loan book and to continue to to run that flywheel and get additional net interest income in the doors because you're building up your capital ratios.
So you think if Noto has to flick a switch to get GAAP profitable, he's trying to do it in a way that when he does it, he thinks they've captured enough market share doing what they could do without being profitable. Because once you flip that switch, as you said, as the capital ratios increase, there's a whole nother sector of growth that could happen for being GAAP profitable. But there's a reason we haven't become GAAP profitable yet over the,
the thing is that we could be GAAP profitable tomorrow. It's just trying to hold all, like, you don't want to see new users next quarter be zero or something like this. They're still trying to get to those milestones without completely flicking off a certain segment of their business. Just slow growth, and that's comfortable as well. Doug did say it correctly. Yeah, it's just leverage, by the way, for the capital ratios, right? You're just
it's
you don't
leverage,
need as much to hold as much. It's levered to a great degree.
Okay, cool. Steve, any thoughts you're gonna say?
I forgot what I was gonna say now.
Yeah, look at his smile, dude. Yeah. Oh my God.
Were you distracted?
Maybe.
He's like a little kid, bro. He's like
he totally like threw his Game Boy away and looked at the teachers. They're like, oh,
Game Boy. Dude, I got a 49-inch curved monitor in back of my laptop.
Bro,
I'm talking
Steve, back
watching
whenever you were a
TV,
kid, I'm sure
plays
there wasn't
video
even
games.
It's a
devices.
metaphor, Steve. It's a metaphor. He's not being literal.
I love it.
All right,
Well,
back when you
I
were
mean-
in school.
When you talk about dilution, it really depends what dilution would come from. Like Technisys, some people were not okay with the dilution. I was fine with it. So it really depends what they're using the dilution for. But
It's okay if you weren't listening. Like you can.
no, I
Okay.
was, but I forgot what I was going to say.
Okay, go ahead. Go on with your Technisys dilution. Go ahead.
No, that's all I was going to say on that. But as far as leaps and what Amit was talking about, what was the price you were talking about? $12.50 by January.
$15 by
2025?
January
Well,
2025.
the conversation was a Twitter little exchange Chris had that maybe the stock, it's ambitious to assume a 3x by 2025, but he's clarified his thoughts. He says it's not ambitious. It's just a question of,
Yeah.
when.
I mean, it is ambitious, right? Like
we covered-
any
we-
company
You got to think about it like
tripling
this. Past
in-
performance, because SoFi was at 24 during 2021 or 2022, early 2022, is not a guarantee of future performance. And look at Cisco. Cisco has never made it back to its all-time high, yet I think they've quadrupled their revenue and 2 or 3x their net income and free cash flow. I'd have to relook at the numbers, but you look at their growth on the financials, they've never got back to where they were in 99 or 2000. So things like that
But
could
Cisco,
happen.
you can't compare Cisco to SoFi. That's
So, but here's
like
why.
comparing Intel to like,
So think about this. I said today in the article, I think SoFi is going to be at $10 before the year's over. I could be 100% wrong, but there are catalysts that could get more money to come in and buy shares. You have being GAAP profitable by Q4, not in Q4, by Q4. They will be GAAP profitable, so the CEO says. You also have student loans possibly coming back mid-August.
it's coming back, bro. The Supreme Court's gonna knock that shit down. And
We don't know. That's why I'm
like
saying
Biden
maybe.
said, we're done with this emergency shit.
Look,
like it's gonna coming back. It's coming.
We don't know. It could get extended again. and
How.
you need
I
to
don't even
wait.
know how it could politically get extended. I have literally no idea how.
Let's not get political. It may or may not happen. Let's see what happens in August. Let's be down the line.
By the way, I have
moderate.
loans, so it affects me. So I
Okay,
gotta,
let's be very moderate. It may or may not happen. We'll know in August. And then if the tech platform plays out and if member growth continues to be what it is, and if we get some news about a large financial institution going from proof of concept to incorporating the tech platform on their end, this could become a hybrid valuation company where it's not just valued as a traditional bank, it could get aspects of being a tech company. So there are catalysts. And look, I love what Carlos says on Finance Junkies about what's the headline. And those all could be the headline that gets it there. Is it going to get to 10? I have no idea. I think it is. And over the next decade, if they perform and if they come through on the things that they say that they are going to do, I believe that this will be $100 billion company. Am I right? We're going to need a
$5 billion
decade to
company
find
right
out.
now.
So that's a 20x.
yeah, yep.
Maybe I'm right, maybe I'm wrong, but a lot of things have to go wrong for that premise not to play out anywhere in that ballpark. But I think a lot of things are going to go right. When we think about Noto as an operator and you look at his pedigree of what he's done, I'm taking him at face value with these things. So we'll see if I'm right or wrong.
Okay.
So SoFi to $100 from Steven.
But I'm saying in a decade. It's not like I'm saying 2024. I'm saying 2023.
I thought you said
my
June
game.
2023. I thought that's what
No.
the price.
2033, I think it could be a $100 billion company. That's my investment thesis based on where I see them growing into and looking at the other banks that are top 10 financial institutions.
Well, he did say, real quick, I guess, to finish off, he did say when he was talking about where he wants to see them in 5 years, right? And he said, and he's talking about what he wants to see by 2025. He said, we want to be a top 10 financial institution by things like market cap that banks are measured by. So he actually said specifically market cap. And if you go and you look at what are the top 10 financial institutions in the United States and what are their market caps, number 10 is Truist. which has a market cap of over $40 billion, right? So from where we're at right now, that's an eight bagger in like 5 years. I don't remember if he gave an exact timeline on that, but maximum like 5 years. I think he was talking about like 2025, 2026, if I remember correctly. I might be wrong on that. So
Noto's
don't
incentivized to get to 2025 by 2026.
Oh, he's
Or
definitely
$25.
he's incentivized to get to 45, right? If they get to 45, then Noto's net worth increases by something like $200 million.
And my
Crazy.
net worth increases by like 200,000. Like it's gonna be crazy, right?
Yeah, no, if they get to 45, I'll be fine.
Will you retire at 45, Chris? Would you be done? $5 a share? Are you calling it quits with your 23,000 kids? And
I've only got 5 kids, man.
Only.
It might sound like 23,000 sometimes. It feels like 23,000 every once in a while. No, I don't think I'll ever really retire. So even if I'm financially independent, I want to do something productive, right? Like I want to add to society.
I think all of us would, but would you have the means to retire at 45?
Probably, yeah.
Probably. Okay. Cool.
I want to hear it live before we go to the Palantir Weekly. Steven, Chris, let's do a couple personal podcasts, and I won't ruin ours, Steven, again, or Chris. His whole
I
audio
heard
got
about
corrupted
that.
last
That was
time.
sad, man.
I felt bad, yeah.
It was a great conversation too. It was actually great.
It's life.
And now it'll never be heard. Unless we redo it, guys. Sign up. Do it. Say it right now. Say it live. Do it.
If I have another night shift at work, I'll do it again.
Okay. Steven?
I already told you yes.
All right. Love you guys.
I mean, it's like the third time you've asked me today. Like, I already told you yes.
Tomorrow.
He's just texting him every day, like, yo,
No,
Tomorrow.
because he won't get WhatsApp. Guys in Canada doesn't want to freaking text me, wants me to go on Twitter. Like I'm gonna remember to check my messages on Twitter.
This guy's so funny. He's like, just text me. I'm like, I don't have an American phone. He's like, I'll pay for it. I'll pay for the whole monthly bill. Just text me. Like, I'm like, relax, Steven.
All right, that's it for us, everybody. Thank you for being here. Chris's link is not in the description, so I'm putting Data-Driven Investing on Twitter in the description. Definitely check it out.
Real quick. The best thing about a free market society is nobody has a gun to their head to invest in SoFi. So if you think the CEO and the CFO are wrong, don't invest. Nobody's forcing anybody to invest, and you can go the opposite direction on it.
So what's going to happen is exactly what's happening with Palantir right now, where everybody was like, oh, screw this company at like $7. And now that it's $12, $13, everything that I'm seeing on my Twitter feed. Is it too late? Can I still get in? Is this still a good price?
Too many people are nearsighted. Look, when I make investments like this, I'm thinking 5-10 years down the road, and I don't care about price fluctuation because if it goes down, I'm not selling. I'm buying more unless my thesis changes. But too many people have this short-term mentality and want to be a swing trader or want to be a trader. Investing is a long-term game.
And if you guys disagree with that, Data-Driven Investing and Vadim will argue with you for hours on Twitter with no end. So, geez.
It's only okay. Here's the real quick, just like 2 seconds. The main thing that I don't like is like if you look at those threads, Vadim and I will like quote the 10Q and like put up screenshots and other things that like prove our points, and then there's just this rhetoric on the other side. Here's the thing: opinions are crap.
100%.
Right? Data is evidence. Opinions are just noise.
Data-driven investing. Yeah.
That's why I'm data-driven investing, right?
No,
like,
I feel that with Palantir as well. People call them evil, and it's just nonsense. It's like, where's the evidence here? You know. So
anyway, you got to get to Palantir Weekly, so we'll let you go, and I gotta get the rest of my kids in bed.
Dude, do you notice how it's like literally daytime here?
Yeah. Good morning to you, Tevis. We'll get some coffee.
Fucking good morning, guys.
All right. See you guys.
All right, everybody. See you next week. Bye-bye.
See ya.